Hi, welcome back once again to CBSE Board Economics. Under monetary policy, one of the important instruments to control excess demand and deficient demand, to control inflation and deflation or depression in the economy is varying reserve requirements. What exactly is monetary policy? Monetary policy is the central bank's money supply and credit control policy. Through monetary policy, the central bank tries to control money supply in the economy and also the credit creation in the economy. Sometimes the central bank wants to have more cash reserves with the commercial banks, more money supply in the economy. Sometimes the central bank wants to have less money supply in the economy. Sometimes the central bank wants to increase credit. Sometimes they want to decrease the credit. How do they do it? Through monetary policy. That is called varying reserve ratios. What exactly is varying reserve ratios? Varying reserve as per the guidelines of the central bank. Every commercial bank is supposed to keep some cash reserves with the central bank or with themselves. That's called varying reserve ratios. What exactly is varying reserve ratio? As per the guidelines of the central bank, every central bank is supposed to keep, every commercial bank is supposed to keep some reserves with the central bank or with themselves. That is called varying reserve ratios. As you can see here, commercial banks are obliged to maintain cash reserves with the central bank on two accounts. Under this, you have two varying reserves, cash reserves on two accounts. One is called CRR, cash reserve ratio, and the second one is called SLR, Statutory Liquidity Ratio, cash reserve ratio and statutory liquidity ratio. Let's see what are these. What exactly is cash reserve ratio? CRR. Cash reserve ratio, under CRR, the banks are required to deposit with the central bank a percentage of their net demand and time liabilities. What exactly this means, or in simple words, you write it, as per the guidelines of the central bank, every commercial bank is supposed to keep with the central bank certain cash reserves which they have in terms of maybe demand deposits or time deposit means fixed deposits they have. Suppose if the cash reserve CRR is 5%, the banks are supposed to keep 5% of the cash they have with the central bank all the time. They can't give it as credit to the commercial banks. That is CRR. Cash reserve ratio is the commercial banks are obliged to keep a percentage of their demand and time liabilities, or the cash reserves they have to keep it to the central bank. That's called CRR, cash reserve ratio. The second one, we call it as statutory liquidity ratio, SLR. What exactly is SLR? SLR, cash reserve ratio and statutory liquidity. SLR is different from CRR, slightly different. What exactly is SLR? The banks, commercial banks, are not only obliged to keep a percentage of the deposits with the central bank, but also they have to keep a percentage of their cash deposits, maybe their demand deposits or time liabilities or time deposits, that's fixed deposits they have to keep it with themselves all the time without lending it to the general public. That is called SLR, statutory liquidity ratio. For example, if the central bank is, if the CRR is 5%, that means 5% of the reserves commercial banks are supposed to keep it in the central bank, and SLR is also 5%, they have to keep 5% of the reserves they have with themselves. That means the commercial banks are all the time obliged to keep 10% of the reserves without giving it as credit or lending to their customers. They can lend only 90% of the reserves they have. Now let's see, how does it help in controlling inflation in the economy, in controlling depression? You can see on the other board, if there is excess demand or inflation in the economy, The prices are really going up. There is too much inflation in the economy, which is bad, we know it. What does the central bank do in case of inflation or excess demand, inflationary gap? The central bank increases both cash reserve ratio and statutory liquidity ratio, that increases CRR and SLR. As a result, the commercial banks have little money or small reserves with them to give it as credit. As a result, the credit creation capacity of the commercial banks will slide down, come down. When the credit creation capacity of the commercial banks come down, so the money supply in the economy will come down. When the money supply comes down, aggregate demand for goods and services will come down. When it comes down, as we know it, the price of commodities automatically will come down and inflation is controlled and inflationary gap is reduced. That is in case of excess demand. What does the central bank do when there is deficient demand or deflationary gap or depression or recession in the economy? In case of deflation or recession in the economy, what does the central bank do? The central bank, the main purpose central bank is to control recession, not depression. Output is coming down, incomes of the people are coming down, output is coming down, production is coming down. It is leading to underemployment equilibrium because the employment level is coming down. What does the central bank do? They decrease cash reserve ratio and also they decrease statutory liquidity ratio. They decrease both CRR and SLR. When they decrease both of them, automatically what happens? The cash reserves of commercial banks will go up. When the cash reserves of commercial banks go up, the credit creation of commercial banks will increase. When the credit creation is increased, automatically there will be more money supply in the economy. Automatically the production will go, aggregate demand will go up. As aggregate demand goes up, production will increase, income will increase, output will increase, employment level will increase, and the economy again comes back from underemployment equilibrium to full employment equilibrium. So we can control both these things. So we repeat once again what we have seen. The first thing you remember, monetary policy. Monetary policy is the central bank's money supply and credit control policy. Under monetary policy, one of the most important instruments of the monetary policy is varying reserve ratio. What exactly is varying reserve ratio? Varying reserve ratio means commercial banks are obliged to keep some cash reserves with the central bank. Under varying reserve ratio, there are two reserve ratios the commercial banks have to follow as per the guidelines of the central bank. One is cash reserve ratio and the second one is statutory liquidity ratio. What exactly is cash reserve ratio? CRR. Under cash reserve ratio, commercial banks are supposed to keep or obliged to keep a part of their demand and time liabilities with the central bank all the time without lending it to the general public. When they are keeping cash reserves, when there is excess demand in the economy, the central bank increases CRR, cash reserve ratio. When there is deficient demand, the central bank reduces CRR. What exactly is statutory liquidity ratio? SLR. It is the same thing. It is the reserves. The commercial banks are supposed to keep it with themselves. This may be time deposits or demand deposits. They have to keep it with themselves without lending it to general public. That is CRR and SLR. What does the central bank do in case of excess demand, inflation? They increase both CRR and SLR and reduces the credit creation capacity of commercial banks. There will be less money supply in the economy, aggregate demand will come down, automatically inflation is come down. In case of deficient demand, the central bank reduces the CRR and SLR and increases the credit creation capacity of commercial banks. As a result, there will be more money supply in the economy, output will increase, income of the people will go up, employment level will go up, and depression or recession is controlled. That's it. So you have to remember here, cash reserve ratio, statutory liquidity ratio, how do they help in controlling inflation and deflation? That's all we have time for this video. Till we meet next time, it's goodbye from Saddam Hussein. Don't forget to subscribe and share, like our videos. Till we meet next time, bye-bye.